Hello, everybody. I hope everybody is having a good afternoon. And here we are again, right? I say this every single month. I feel like they go by very, very fast. Hello to everybody that is giving me the wave. Hello. I recognize many of your names. Actually, let's start with where everybody is. I just love doing that just because it's fun. Shoot me a text of where you are right now. I just find that so fascinating that people are from all over the place. In any case, Brisbane. Well, that's just about as far away as you can get from me. Massachusetts. I used to live in Massachusetts. Lived on Cape Cod for a while, actually. Oslo, Brazil, Los Angeles, England, Seattle, Vegas, Virginia, Argentina, Texas. Another Oslo. Two Oslo people. Do you know each other? That's always the joke, right? You know each other. And North Carolina. Man, this just fascinates me. It just really does. I don't know. I just think that is so cool, right? I mean, who would have thought when I was a kid, at least, that I'd be sitting here in my office, in my house, being able to talk to you people live all over the world? I just think that's the coolest thing. I don't know. That's cooler than the eclipse. In any case, thank you all for joining me again. I hope that you guys are all seeing very clearly how important environment is, right? How very, very clearly environment can change and how important it is to be in tune with the environment and understand if you should be operating aggressively or not due to that environment, right? I hope you're all getting this because if you've been with me for a few months, at least a few months, or hopefully longer, we have had a major change in environment over at least, let's call it the past couple of weeks, right? I mean, the environment has changed many, many times if you've been with me for years, but hopefully you see the change of environment between that move off of the October, November lows of last year up into about March of this year. Then the environment changed again, right? So we had the tailwind on our back. We had a trend moving higher. Exploit that trend. You don't have to get in on day one. You don't have to get in on day 10. And you don't have to get out exactly at the top. But you want to exploit that trend. And the trading was so much easier during that time period, right? To the upside. It's never a simple 2 + 2 = 4 type of thing. It's not colored by numbers, right? So I'm never going to call it easy, but you certainly had that tailwind at your back where you had a favorable environment, where you had the probabilities in your favor. And now that is just not the case right now. It's just not the case. If you are making gains, good for you. But I would say, recently it has been chopped. Today was just absolutely classic textbook chop. Double inside on the SPY and the Qs right near their 20s. It's as if the market is waiting for something. I would say that is CPI, right? So CPI comes out Wednesday morning. I'm not going to get into the day's movement, but I wanted to really bring out the point that environment is so important, and I hope that you are all, particularly the newer traders, starting to see what a difference the environment makes. We can have setups all you want. I see setups out there, but they're just not going to go the way they were going in January and February when the market is choppy. That's just the reality of it. It's like that analogy I talk about. If you go to a casino, and I like to caveat it by saying I do not consider the stock market as going to a casino, but it's a decent analogy, because if you walk into a casino and there's a big sign on the door that says, you know what, we've changed our slot machines, we've changed things with our dealers, your winning percentage today on everything you want to gamble on is only 25%, right? Come back tomorrow if you want the odds to go back to 50-50. I'm making numbers up, but you get the idea. If the market is not moving in your favor, it's like there's a sign hanging on the wall. Your chances of winning here are decreased. Do you want to, be super active when that's the case, or do you want to wait for the environment to change? I mean, it's kind of as simple as that. And what you have to do is recognize when the environment is providing a tailwind. So I say all this because today I'm going to do frequently asked questions, and the answer to most of these frequently asked questions is it depends on the environment. So I bring that up again because I really, really, really want to hammer home how important the environment is, because all these questions that get asked, the answer is always going to involve some sort of evaluation of the environment, because you need to adjust depending on what is happening in the environment. You have to either be aggressive or defensive, or if you are simply getting chopped up and you don't know, let's say you're a beginner trader and you really don't have much experience, then you absolutely by nature should be defensive, simply because you don't have the conviction or the experience to understand, the difference, right? So I would argue that in the beginning, if you are feeling just completely lost, adopting defensive tactics kind of across the board makes sense, right? So there should be no expectation that you simply declare yourself a trader, and then suddenly you're going to make tons of money really quickly, right? Watch my realistic expectations webinar to be a little bit more grounded, optimistically grounded, but grounded, right? So I just wanted to make that little point in the beginning that most of these frequently asked questions are based so heavily on the environment. So that you're going to hear that a lot today. And you're just going to hear it a lot because that's the way I trade it, right? It's incredibly focused on the environment because it makes all of the difference, right? I see 4 or 5 good setups right now. If it was January, I'd feel much more confident about taking them. But given the fact that I've been seeing what I'm seeing now, I think the odds are much, much more reduced that any of those will work in your favor. They may pop and drop, exactly what chop is. And the thing is, chop works both ways, right? So it's not like you can just be like, oh, well, let's just short the market, because that's not reality either, right? We're in an uptrend. So getting aggressively short here is not exploiting the trend. All right, I'm going to share my screen. This is going to be less structured than usual. Now, what do I mean by that? I don't have a PowerPoint, so I'm not going to sit here and flip through slides, right? I'm gonna look at some charts, and I'm just going to tell you guys the general categories of the questions that have been asked. So I had a general idea of the frequently asked question categories before. I assume you guys can see this shared screen and that it has worked. Somebody tell me if you can't. But I told you guys, I put a little post on the site that said, I'm going to do this frequently asked questions, and I have a really good idea of what these are going to be, but please send questions in. People did send questions in, and thank you. And I think they mostly neatly fit into the categories that I already had. So that gave me like a little more confidence to feel as if I've kind of got a good handle on the frequently asked questions. And I've been doing this for 3 years. So I have a pretty good understanding of the most frequently asked questions, right? And it is what it is, right? I think there's a reason why people ask certain questions. And I don't fault anybody for asking questions, so please don't read anything I say that way. But I do think I try to frame things differently, perhaps differently than maybe other services or other traders out there, particularly on Twitter. I want to frame things a little bit differently with the goal of empowering you to understand the dynamics behind what you're doing, so that you can actually engage and start to have more conviction in what you're doing, or at least more conviction in what how you are operating in the market. Meaning you're not looking for somebody else to tell you exactly what to do. You are starting to understand the dynamics at play and understanding your decision making and how it affects your account. So that's the reason for everything I do here, is trying to help people kind of get to the point where they really have a good understanding of the dynamics at play and are able to then build their own, I won't call it a system, but build their own methodology, their own logic behind trading, their own tactical approach to trading based on the millions of different variables that are out there, right? Somebody who's in Brisbane is not going to trade the same way I trade, because they're not going to be awake during the market hours, right? So we all have to be aware of our own unique situations. And somebody who is 30 is unlikely to trade the same way as somebody who is 60. It's not a blanket statement that I can say with 100% certainty, but you get the idea. There's going to be different risk tolerances. You're in different points in your life. Your account may be wildly different. Somebody with a $10,000 account is going to trade very, very differently than somebody with a $1.5 million account. Huge differences. Although we all share some commonalities, which are the risk management, the way we're looking at the market, your general overall strategy, which for me, as I've explained many times, is exploiting a trend, taking advantage of the natural trending tendency of a market, which is one of the things that actually makes a market tradable, in my view. In any case, I think you get the idea here with this intro. Environment, extremely, extremely important. So most of the questions, first of all, I'll say that probably the most frequently asked questions is some variation of thoughts on XYZ stock. What are your thoughts on XYZ stock, right? And when I was first launching a trading service, I joined just about every service out there. Well, I shouldn't say that, because there are gazillions of them, right? But I joined probably 10, I guess, so not even anywhere close to all the services out there. But I joined about 10 to see what was going on. And I mean, that is the question that gets asked more often than not. And especially alert services, people are just, what do you think of this stock? What do you think of that stock? What are your thoughts on this stock? Thoughts on that stock? And to me, I will say, I get why people are asking that. Overall, I think that is, looking at a very kind of narrow view of the market, right? You're looking trade by trade. You're looking at a single stock setup, trying to glean information from asking somebody what they're thinking about it. And to me, what it is, honestly, is people looking for confirmation, right? If you're asking somebody, there's a couple reasons you'd be asking that, right? One is you're in a stock and you have absolutely no idea why the hell you're in a stock. And you're asking for somebody basically to tell you what to do with it. If that's the case, well, you should not be trading at all, right? So that's one base scenario. If you have no idea why you're in a stock, you have no logic around your trade whatsoever, and you're just asking somebody to tell you what to do with it, that is the worst case scenario of that question, right? Of what do you think of this stock? I don't think most people are doing that. Some people do. I think what most people are doing is they recognize a setup in general, and they're just saying, hey, you person who is more experienced than me, confirm this for me. Tell me if I'm on the right track. Let me know if I'm seeing the thing you're seeing. And I would say 95% of the time you are, right? Well, because there's no mystery here, right? You can see that on this chart net, I think we can all see this downtrend line. It's on key moving averages. If somebody said to me, what do you think of net? I'd say it's right up against the downtrend line above all, right on sitting on all key moving averages, right? I would say the obvious that we all see, right? What I think people are asking for when they ask that question is, what's going to happen to net? Tell me what's going to happen so I can get confirmation from you and I can make this trade work. That's honestly what I think most people are saying when they say that. So I think it's not a valuable question. So I really, that's one of the ones that I think should be shelved unless you have a specific, maybe technical question or a process question or something like that. I think the least valuable question is thoughts on XYZ, because I don't know what you're doing with it. I have no idea if you're in it or just looking at it. I have no idea if you want to go long or short. It's such a broad, nebulous, kind of pointless question. So that's probably number one. And I think I just kind of put it in context, so maybe we don't have to deal with it anymore. Other questions fall into categories. Stops, biggest one, right next to thoughts on XYZ. What do I do with stops? Where do I put my stop? How do I put my stop in the right place? Blah, 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 blah. That stops are the biggest thing. And I think that is everybody's instinct. Where do I put a stop? Partials. How do I handle gaps? How do I make a watch list? Do I use intraday charts? And how much should I expect to make using your strategy? Those are the main topics here that I'm going to go through, and I'm going to rifle through them. And as I said, this is going to be kind of loosely based. I don't have a PowerPoint. I'm going to use charts to kind of make my points. And I will say about the kind of daily wrap up. Since this market was so extraordinarily choppy, I've got 4 or 5 names I'm looking at. Depending on how long this video goes, I will either do a real quick wrap up like I usually do at the end of this webinar, or I will simply put out a little written post. We'll see how long this lasts. Right. So first question that I usually get very frequently, where do I put my stop? I'm in this name. Where do I put my stop? Where's a good place to put my stop? Right. So, and I will say repeatedly, the stop placement is I think it's the most uniquely personal aspect of trading, because it is 100% completely dependent on your personal risk tolerance. Now, let's use net as an example. All right, so let's go in here and do some things. And I apologize if this is basic stuff for some people. It's not basic for everyone, and there are all different people on here. So I have this set to $100,000 account for simple math, right? Because I think this makes a lot of sense. And I actually chose net because it's right around $100. So the math is really simple. So let's say, let's not talk about setups, et cetera, except although this is one of the charts that I would consider to be, actionable at this point. It's not a good environment right now, but let's say software starts moving again. This is something that I think is actionable. We're tight here on a key confluence of moving averages, the 920 and the 50. So we all see that inside day here, downtrend line, et cetera, et cetera, et cetera, et cetera. I will even flip to the weekly chart. I like these pullbacks in the weekly chart, as you guys know. So I'd be much more interested in getting a name that is pulled back like this in the weekly chart. So in any case, let's say you want to enter this by the simple strategy of surround today's candle with a trigger and a stop, right? I have an alert set here. Got an alert set on several of these. So I just pulled up the position sizing tool. It is set on $100,000 account. You use your account size, obviously. I have it set at 50 basis points of risk. Right. My entry, I'm doing it graphically. You can enter this, to make it exact to the penny. Right. But I'm doing it graphically right now. And that's not the main concern here. But it's roughly around the top of today's candle, 96.88-ish, right around the $100 mark, too, which is usually a kind of a psychological level. Now, let's see, where do you want to place your stop? Where you can place your stop anywhere, right? This is your stop. It's up to you. A lot of people think, and I think particularly new traders think there is some magic recipe, whereby they've heard so many things like they're stop hunters and, they can see your stops. They can see your stops and they're manipulating it. And then, don't put your stop in an obvious place because they're going to take you out. And I would love to tell you that that's a big load of BS that absolutely nobody can really prove. Are there some market makers that are doing funny things? Yeah. But overall, look, don't worry about somebody seeing your stop or having some magic stop level that, people are going to take out stops. Worry about the logic behind your trade, because that's how you're interacting with the market. You're not trying to outsmart some mystical manipulative force out there that largely doesn't even exist. You're trying to have an interaction with the market that is based on your logic. So my logic here, based on the way I trade, would say, hey, if this takes out yesterday's high, if it moves below yesterday's low, that means I'm just wrong. I'm wrong for now. I'm just wrong for now because I wanted to take out this high and motor. That's the idea of this entire trade. Because you guys have heard me say, I trade with tight stops. I like to trade with stops around 2 to 4%. And that's not just some arbitrary thing. Like for instance, first of all, I wouldn't enter on a day like this. But I'm just trying to make a point. Let's say I entered on this candle, right? Would I just enter right there and then just say, all right, I'm going to place my stop at 2% because that's the way I like stops? Does that make any sense to enter right here and then just place a stop at 2% because I just like stops at 2%? No, I mean, that is not the arbitrary thing. So we have, those of you that may be real big canceling people, I am not one. But those of you that may be real big canceling people, know that William O'Neill advocated the 8% stop or, in that area, a fixed stop, right? For me, that just doesn't make any sense because am I going to, enter in this area and then just arbitrarily say, all right, no matter what, I'm just going 8%. My stops, that's where my stop is because I just said it is. It's 8%. What I'm doing is looking for entries that afford me a logical place where I can put that tight stop, right? That's what a tight chart does. That's what a chart getting tight below a downtrend line on moving average does. It affords you that opportunity where you can then logically place that tight stop. It's not arbitrary, right? So that's one big point here. This is not an arbitrary endeavor, and this is why I want tight charts. For instance, you look back here. This was right before earnings, so there's no way you can play it. But as charts frequently do before earnings, they get real tight. So it got real tight here, right on key SMAs. It's beautiful in hindsight, right? But the risk is real, and this was going into earnings. But there's another area where you could have taken a tight stop. A candle like this does not afford you a tight stop. This area does not afford you a tight stop. It's that simple saying, buy them when they're tight, sell them when they're loose. I'm sure you guys have heard of that. I want to buy tight charts because they afford me the opportunity to take those tight stops, right? Which afford me the opportunity to have a good risk-reward ratio should the trade move in my favor. Now let's talk about where would you place a stop? Where's a logical place to stop? Now there's no magic formula. For me, it's usually surround a trigger with a candle. Surround a candle with a trigger and a stop, meaning surround this candle with a trigger and a stop, just like this. And this puts me graphically right in the 2.5, 2.6% range. I could tighten it up a little bit if I want to. It's also confluent with a 50-day. So you just want to engage your brain and think about things like that. There's a 50-day here. There's the low of day here. That seems like a pretty good place to put your stop, right? And it's up to you. If you want to say, I want to give it a little wiggle room, give it a little wiggle room. Go to the previous day's low. Go down to 4.26%. Now, here's the dynamic that you need to understand. The tighter the stop, especially in a more volatile name, and I will call this a volatile name. There's no doubt about it. I've traded this and have had some success, but have also been chopped up. You have to know your dance partner, right? If this was something like SMCI or Carvana or some super volatile name, you have to even understand even more likely you're going to be chopped out, right? Especially with a tight stop in the 2 to 4% range. So with this stock, you have to understand you have a good chance of getting stopped out. Your chances are going to be higher of getting stopped out if you place a stop at the day's low below the 50 versus if you place your stop here. That's just that's the simple dynamic. It's as simple as that, right? So I think people are asking for a magic number, but the thing I want to stress is these simple dynamics, right? So if you put a stop here, this line is too wide. I get it, but you get my idea. If you put a stop there, you're more likely to get stopped out than if you put a stop here. The choice is yours. And if you put a stop here, you're less likely to get stopped out than this line, right? That's this simple, obvious dynamic that people need to pay attention to, because it's not about some magic number, and anything can happen. Like this stock can swoon on some sort of intraday news. There's no magic placement of your stop. It's about your risk tolerance and what you're trying to achieve and how you're engaging with the market. So this is a super important point that I think people get really confused about. Something else to show this in real terms here. Let's say I put my stop here at 2.6% roughly. Surround this candle with a trigger and stop, right? This is position sizing, telling me if I want a half a basis point, if I want a 50 basis point trade, I'm going to take 196 shares on a $100,000 account. This is a stock. Let's make life easier for ourselves and say that this is at $100, which means that would cost you $19,600, right? We can all agree on that math, right? If you have a $100,000 account and you're putting $19,600 into your account, you are using 19.6% of your entire account in this trade, which is reasonable. That's reasonable. That is not over allocated in my book. I think if you start to approach, hey Ross, I haven't seen you in a long time. I just saw that. If you start to approach, 25%, 30%, you start to have over allocation issues, which is twofold. One is, let's say the CEO of Cloudflare gets arrested for some criminal activity tomorrow at lunchtime. I'm over exaggerating, right? And then stock gaps down 20%. You suddenly have 30% of your account in a stock that gapped down 20%. That's going to hit you much harder than if you had 15 or 20% of your account in that name. So there's that over allocation aspect of it. The other one is efficiency of using your capital, right? You don't want to have a giant percentage of your account in one 50 basis point trade, because it's just not efficiently using your capital. You can use your capital much more efficiently if you do not over allocate. All right. So the point I'm trying to make here is, let's see if I really tightened it up, because as you guys know, and this is going to be the next question, I will tend to cut these early, right? So somebody asked me, why don't you just put your stop at half R? Why don't you just tighten up your stop? See this number, 188? It was higher a second ago. If I bring this stop up to 1%ish, 480 shares, it's telling me, is what I need to size appropriately to take this at a 50 basis point risk. That is 48% of my account, $48,000, right? So right there, suddenly I go from 20% to almost half my account size when you size that close, right? So there's two big dynamics at play here. First of all, when you size like this, I would say fully expect you're going to get stopped out unless this thing just motors, from tick one and motors higher, which can happen. And in the case that does happen, you will have a very good risk reward. But I would say a large percentage of the time, you're simply just going to get stopped out real fast for that full 1R loss. And you're over allocated, right? So that's a dynamic that everybody needs to learn. Play with this tool, right? And learn these dynamics, because it's really simple. But I think people get tripped up on this. I think for one reason is they think there's a magic place to put your stop. And then for the second reason, they're not truly internalizing that this is really about how you want to interact with the market based on the logic of your trade, right? So if I want to take this as a swing trade, potentially up to this high, I want to see where I can get at a 2 to 4% stop. That makes a lot of sense here inside day. I won't be over allocated. I'll have $18,000 in here of a $100,000 account, and it potentially still gives me a nice 7R risk reward, potential 7R risk reward. That's how you size up a trade. Now, conversely, in the other direction, if you are somebody that, if I have tight stops like this is the way I like to trade. I will get stopped out 50 to 60% of the time, sometimes more. I will get stopped out a lot. Like I get stopped out a lot, right? I cut myself out a lot. It happens all the time. If you have no ability to be resilient about that, that's going to affect you more than it will affect other people. I'm just used to it. This is the name of the game, right? You don't wake up and bat 1,000 every day. That is just not how this endeavor works, right? This is a probabilities-based endeavor, and I don't take it personally. This stock didn't do anything to me personally, right? The stock market couldn't care less if I existed on the face of the earth. I am a small time cog in this big machine, right? So it is not a personal thing. But if you are not able to take a lot of stops, some people like to widen it out, or you're in Brisbane or somewhere where you're not even awake, right? And then you have to really understand that maybe you want to loosen things up a little bit so you're not taking all these full R losses while you're asleep. Now, will that skew your risk reward downward? Yes, but you will stop out less, right? So maybe you want to say to yourself, hey, you know what? Maybe what I'll do is, use this low as my point that shows me where I'm wrong, right? I'm going to give it room until that low. You still have a total logic around your trade. I don't know, I just deleted it, but you get the idea. You still have a total logic based on your trade, right? Where am I wrong? I'm wrong here. If it takes out these recent lows, I'm wrong. I'm just wrong, right? And that gives me a 6% distance, so you're much less likely to get stopped out immediately. Now, we'll make no qualms about it. This could absolutely fall 6% in the first 5 minutes of tomorrow's session. There's no doubt about it. But your odds of being stopped out are going to be lower than your odds of being stopped out if your stop is right here, right? What's the trade-off? First of all, you're now putting $8,000 of your account into this trade, so you have a smaller investment in it, which may be good or bad, but you stand to gain less, certainly. And your risk reward is skewed, right? Remember I showed you my risk reward was around 7. This is around 3.34, right? So those are the differences, and you have to decide for yourself. So there's no magic place. So when somebody asks me, where'd you put your stop? My answer is usually low of yesterday's day, below a key moving average. It's as simple as that. The real trick, and it's not a trick, is I'm trying to spot entry points in these charts that allow me to logically place a stop in that 2 to 4% range, unlike buying here, where that is not possible, right? This kind of tightening is what you want to see. Doesn't mean it's going to work by any stretch of the imagination. This could be coming from failed moves, come fast moves, overnight, boom, down to the 200-day. Does not mean it's going to work. What it does is it gives you a place to actually measure your risk against and take advantage of the potential of an asymmetric risk reward opportunity. So I hope this is making some sense, right? So to understand the simple dynamics at play, I urge you all to just play with this tool a little bit. Look at how much you would be allocated. Look at the change in your risk reward. That's the simple. It's really simple, right? I think we could all agree that this is really simple. There's nothing complex about this. But these are the dynamics you simply need to understand and completely internalize. And then you can start to create your own way of interacting with the market. Maybe you want to take double bottom type. I'm just making stuff up right now, right? But just to try to prove a point, maybe you want to take some sort of like double bottom look. Just take a different kind of trade, right? So maybe you come in here as it reverses higher and you want to get real tight. Maybe you take this here. You can make that judgment call, right? You can be like, I want to be real aggressive here as it held this low over here, and let's see if it gets back above the 50. Then you are in charge of how you're interacting with the market. It's up to you, right? You have the logic, you have the framework, you understand the dynamics of the risk reward that's at play, and you can set your own parameters. Once you are able to do that, and it's not hard by any stretch of the imagination, but once you are able to do that, you should really be looking at the market as not as something where you're saying, hey, what are your thoughts on XYZ? It's what are your thoughts on it? How are you going to approach it? What are you going to do? What's your logic here? What's your simple logic? What's the simple asymmetry that you're seeing? Where are you putting your stop based on your understanding of your own weaknesses, your own strengths and weaknesses? If you're somebody that just absolutely can't tolerate getting stopped out 60% of the time, then you got to widen your stops. Or you got to trade less volatile stocks, or both, right? But I would argue that, in this endeavor, you're going to get stopped out a lot. That is the name of the game. You got to develop a thick skin and deal with it. In terms of questions, yes. Did you use wider stops when you were trading while working full time? That's a good question. Let's see. I probably did, but not by much. I was probably more towards the 4% range. And it's been a while. So that's why I can't answer it completely. But it was probably more towards the 4% range. But I have always been somebody who, I've always been in my heart a swing trader, and always been somebody who, I want the stock to move in favor of my trade quickly. I just want I want the feedback quickly. The best trades I ever have are the ones that work quickly. So I like to take the tighter stops, because when those work, you're taking more advantage of it. So then you'll come back to me and say, well, so why don't you just take the super tight stop? It's because you're going to get chopped up a tremendous amount of times. You're going to be over allocated, and you're going to take full 1 hour losses before you can even react. That's why, right? So 2% for me is about as close as I'm going to get. You'll see that in some big mega cap stocks like Microsoft, I will take tighter, and I know I'm over allocated, and I've gone through this before. And I know that I have to dump a decent amount on that position by the end of the day. or I'm holding too much risk overnight. And I already know that, right? But that's me understanding the dynamics of it, so I'm able to work it, right? It's not like looking through a rule book. Okay, on page 487 of the How to Trade, how to get rich trading rule book that doesn't exist. It tells you exactly what to do. That's not what it is. It's about understanding the dynamics and how they're going to work for you and how you're going to use those dynamics, right? So it's a really, really simple concept, but I think so many people just don't look at it this way. So maybe it makes things not as clear as I think they make things as clear to you, and everybody's going to react differently. But hopefully, it's a way of reframing possibly the way you're looking at it. If you're somebody who is really confused about how you can control your own stop placement, because you should feel good about where you're putting your stops. You should say to yourself, "I'm wrong at this level." Period. It may reverse. Things reverse all the time. And guess what? This is part of the question too. Is I'll just take them again. If it reverses and it's still set up and it's moving higher, just take it again. Just take it again, right? So that's part of this question is how do you cut them early? How do you know you're going to cut them early? And no, I'm not going in 5-minute charts. That's a different topic too. But it's a broader strategy. So here's the question: do you always kick out of stock or only when you're being defensive? It's a broader strategy whereby I am saying I'm going to keep my losses tight. I'm going to keep them really. I'm going to try to cut down on my losses as much as humanly possible. That's the overarching strategy. And how do you actually enact that in your trading? You cut them. You cut them, right? There's no science. There's no like staring at a 1-minute chart and saying, oh, based on the MACD and the 14 other indicators on my chart, this means that I should cut it. It's not like that, right? This is an endeavor where you have to be a decision maker. You have to be a decision maker. There's no sign that's going to come on the screen and tell you exactly what to do. There's no squiggly line that tells you exactly what to do. I won't go off the rails too far here, but once I make the decision, I'm going to cut things, right? And I've been cutting things quickly since honestly 2022, right? And I actually have been enjoying it, and I'm probably cutting more often. Quickly more often than I used to do. In 2020, I was letting things run. I would let things play out because you had during the real, rocket ship period of 2020, the wind was so at your back that even if a stock moved lower, you just had the general probability that it was going to turn around pretty quickly and move higher. So I was much more lackadaisical, was not cutting things super quickly then. So it is about environment. So when you ask me, or only when you're being defensive, it's not necessarily only when I'm being defensive, but it is about the environment, right? So, and this is going to be up to you. This is where you have to figure it out. What works for me doesn't necessarily have to work for you. You just have to understand the dynamics, right? So when I'm cutting something quickly, it's because I want my losses small. How do I achieve that? By cutting them quickly, right? Am I going to take more stop outs than usual? Yeah. And I don't want to confuse you by calling it a stop out, but stopping myself out. If this moves down here, and I cut it here, then yeah, my win percentage is going to likely be lower, right? And I'm usually taking losses 50, 60, sometimes 65% of the time, right? My win percentage will go lower, but I'm still profitable because of this. See this blue section? When I get the ones that work, that's why I'm still profitable. Keep this side small, keep this side big. That's how you have to get the math. Now, there's no magic to it. And you can't just say, I'm going to keep this side small, keep this side big. You have to be operating in the right environment, exploiting trends the way I'm exploiting trends, capitalizing on some nice consolidation patterns and being in stocks that are strong, right? So those are the larger picture items. But the math of it is keep this side small, keep this side big, right? So if I decide I'm going to keep this side really small, the only way I can actually cut it below 1R is to have some sort of reasonable space here, right? If it's like this to begin with, I'm never going to be able to cut it early. So if I have some reasonable space, 2 to 4%, I can still cut it quickly. And like I've said, in certain market conditions, like chop right now, chop. If something moves against me, I don't want to just sit there and wait and have it chop around all over the place. I'm going to cut it. If it comes back to break even and I want to get back in it again, I can get back in it again. I've done it many times. That's the way I operate with that. So that handles a bunch of questions that are part of the stop universe. In fact, I think that handled the first two big ones, but you have to figure out what works for you is the like underlying theme here, obviously, but you got to really understand these dynamics, and understanding these simple dynamics, I believe, really, really empowers you, right? If you work all day long and you can't stare at the screens, you have to be a little bit different. You have to understand what's going to work for you, what's not. You probably want some slightly looser stops. You're not going to be able to stare at the screen. Something you can, people ask me all the time, can I do this? Can I do that? Can I cut half my position at negative 0.5 R? Of course. You can do anything you want. You can structure, be creative, problem solving. You'll never see a trader out there that hasn't done some creative way of solving a problem for themselves. You'll just never see a trader that hasn't done something like that, right? You have a problem, figure out a way to make it work. You can't look at the screen between 10 and 3 in the afternoon. Maybe implement a thing where you'd cut half of your trade if it moves below 0.5 R. Cut half of it, right? I set it to be automated. So that way, if it moves below the 0.5 R, you've cut half off. If it goes all the way down, you've lost less than you thought you would have lost. If it comes back, then you have taken some risk off, right? So just think of ways of adapting, not adopting. Well, it's adopting a strategy too, but think of ways of using these dynamics to solve problems that you have instead of thinking that there's a right answer, because there is no right answer. The right answer is to really start to understand your logic. The right answer is what's right for you. That's the right answer. That is what I'm trying to stress, because I think that most of these frequently asked questions come from a place of, I don't really understand the dynamics here, and I'm looking for you to give me the right answer, like it's a video game, or like it's not even a video game, because there are variations in video games, like it's a physics formula, right? You want to learn about electromagnetism, there's going to be a formula that tells you exactly how it behaves. And we're not going to get into quantum physics where things don't behave the way you expect them to behave, but let's keep our feet on the ground. Physics equations are going to show you the way something is going to behave all the time, day in, day out. As long as we live on this planet with the same laws of physics, the rules apply. That is it under every scenario. If I drop a bowling ball off the roof of my house, gravity is going to affect it the same way as if a car goes off a cliff, right? Those rules of gravity, the mathematics involved in it, are going to be the same every single day for the rest of my life, period. There's an answer. That's not what trading is. There's no answer. You have to really tailor this to yourself by understanding the dynamics at play. So hopefully I'm making that point really clear. A kind of tangent to this is, how do I protect break even? How do I make the decision that I'm going to protect break even? When do I do that? And again, it depends on the environment, right? But like I've been doing, honestly, since 2020, I've been pretty aggressive with it, because I have found that to be something that over time actually keeps my equity curve really smooth. And I really do enjoy that. It keeps my equity curve smooth. I'm able to cut positions out quickly and re-enter if I want to. Same with break even. So let's say I took this stock here, right? That may not be the best example, but I'm going with it anyway. Let's say I took this stock here, right here, for whatever reason. I'm just trying to make it a visual example here, right? So this would have gotten up to about 1.5 R, but let's say for whatever reason I didn't take a partial and it came back. I will make the decision to protect break even if I've made any material progress, right? If it's just chopping around, it's like a doji day and it does nothing. What I will do is at the end of the day, cut it in half. If the stock has actually moved a decent amount, and you're going to say, what's a decent amount? And my answer is going to be, it depends on the stock. This I would call, any rational person with common sense would call that a material move to the upside, almost a 1.5 R. And I'd argue I should have absolutely taken a partial, right? Let's pretend like I was spaced out and for whatever reason didn't take a partial, and this thing came back to break even without me taking a partial. I would cut it at break even, because it made a material move. Now, a material move is something that's hard to define because it's different in every stock, right? A material move in a wildly volatile name, maybe 7%. A material move in NVIDIA these days, maybe 1.5%, right? So it's a judgment call. That's why there's no like answer I can give you when you guys ask for an answer. Has the stock made a material move? Like, engage your common sense. Has it made a material move, or has it kind of doji candled around doing nothing, right? So there's differences, right? And if we get a kind of doji candle around here doing nothing, and it's right at my break even, I cut it in half at the end of the day, because it reduces my total open risk, right? And yes, in a rocketing environment in February, March, I would give it a little more wiggle room. There's no doubt about it. I'd give it a little more wiggle room, especially after taking a partial. Then you have the ability to mathematically give it a little more wiggle room, because your cost basis has actually changed, right? So, well, not I shouldn't say it that way. But what has changed is your break even has changed, right? So that, those are things that change due to the stock itself, because the volatility of every stock is different, and the environment, which is different. This is exactly why there are no hard and fast rules. Because think about the absurdity. I've said this before, but think about the absurdity if someone tried to, sell you some package where it says, put your stop at 4%, no matter what the stock is, no matter if it's bull market, bear market, choppy market, matter if it's in a leading sector, it doesn't matter. Put your stop at 3%, then take your gains when that stock gets to 6%. Period. That's all you have to do, right? Think about how absurd that is as a strategy. It's completely, random. First of all, it has no bearing on the logic of anything, and the variabilities of the stock market, the sector, all of it are not taken into consideration, right? So think about the absurdity of thinking, that there should be some single right answer for all of these questions, right? I really get why people think there are one of these answers, because a lot of people are trying to sell you these answers. A lot of people are trying to tell you, this is how you do it. This is how I make $70 million every morning before I eat my bagel, right? Don't listen to that baloney. I'm exaggerating, obviously, but there's a lot of that out there, right? So don't listen to that stuff. This is about figuring things out for you. Any legitimately successful trader you see that's out there does this. They may not trade the way I trade. They may not take the setups I take. They may not do trend trading, exploiting consolidation patterns, etc. There's a million different ways to trade. What I mean by this is they understand the dynamics and have adjusted them to suit them. That's what they do, and they'll find creative solutions to their own issues using those dynamics, by understanding those dynamics. That's why the traders that you see that are out there that are making decisions, they're not asking for other people's input. They're making decisions because they've figured out how these dynamics are best suited to them. It doesn't mean they're killing it all the time. It means that they understand when and when they don't want to execute. And they don't have to ask somebody else because they've decided upon this being the way that it works for them. This is like super important stuff that nobody really ever talks about, at least I don't think. And I think that it is very, very critical. If you want to take the move from being somebody who is constantly looking for some sort of input from somebody else, whether it's Twitter, CNBC, whatever is out there, noise. If you want to move from that person to the person that is, executing based on your own logic, so you don't have to ask somebody else for confirmation, then this is the mindset you have to employ, is that you're in control of the dynamics. You understand the dynamics. You are the one that is tailoring your decision-making to yourself, right? Now, all the larger picture stuff I've covered a million times, right? And I'm not discounting any of that, right? So, all of the things we're talking about here in terms of price action and the weekly chart price action and, exploiting the uptrend, which is clearly a structural uptrend here, all that price getting tighter here on key moving averages, all that stuff you want to pay attention to. But in terms of executing and where do you put your stop, how do you protect break even, where do you take your partials, that's going to be up to you. So the partials, the other end of this, which is the 1, 2, 3, fourth question in this set of, I think, seven or eight. Where do I take my partial? It's the same thing, right? Depends on this one, they all depend on the environment. But this one, if you're not adjusting where you take your partials based on the environment, then you are really missing out. You're really, really missing the broader picture, right? So in a super, super choppy environment, which I'd argue we're basically in at the moment, right? That can change. I'm going to be more likely to take my partials when I have them. 1R takes them off, right? In 2020, when things it was just nonstop chop, I'd take half a position off at 1R, sometimes 3/4 of a position off on 1R, because that was all you were going to get before it reversed lower, right? So if you're not paying attention to the environment and reacting, then you're missing the entire larger picture by thinking that there's some secret formula out there. The secret formula is that you have to adjust. That's the secret formula. You have to adjust. In the stronger trending markets like we've had from October through March, I'll call it, I started taking partials later in the game. Start looking to take a partial, stretch it if I can. Let the stock go to 1.5R, maybe even a little more. Sometimes I had stocks that were moving so fast, they just went there without me being able to take a partial. That definitely happened. And by the way, that is a big sign that the environment is providing a tailwind. That in itself is a big indicator, right? If you're seeing stocks that rip out to 1.5 hour really quickly before you can even really get your bearings, then that means you're in a much more conducive environment, that where, as opposed to them just, dogying around here, having an arm wrestling match with your break even and barely ever getting up to 1 hour, right? So you have to adjust. So where do you take a partial? It's going to depend entirely on the environment. I recommend taking your first partial somewhere between 1 and 1.5 hour if you can get it. The size is going to be dependent on the environment. In a super choppy environment where you're being very defensive, maybe you'll take half off because that's all you've been getting, right? And there, it's even more important to cut your trades really, really early. And in 2020, this was something I harped on all the time. The only reason I was profitable in 2020, I think I was up 19% in 2020. The only reason I was profitable was because I mercilessly cut losers. I mean, cut them like crazy. And my win percentage was down to something like 32%, something like that. But I cut losers very, very fast, which dropped my win percentage. And I was only getting out to maybe on the winners, maybe 1.25 R, something like that. But if you have, let's say, a loss, your average loss in terms of R is maybe negative 0.25, and your average win is 1, you're making asymmetric wins versus your losses. So even with a lower win percentage, you can be profitable. So those are the dynamics you need to pay attention to, right? So I recommend taking, a partial between 1 and 1.5 R, depending on the environment, and the size depending on the environment. And here's where you have to engage your brain. There's no formula. You have to engage. And I don't mean this to sound in any way somehow putting like I'm putting anybody down or trying to be somehow looking down on anybody, or I guess what I'm trying to say is I'm not trying to make light of the fact that this can be very confusing and difficult. What I'm trying to say is that you should be empowered. You should feel empowered. Whereas I think a lot of other sites, honestly, almost intentionally try to keep you from feeling empowered, almost feel like you have to be, like you can't make a decision. You have to follow these rules. I do not see it that way. You have to have a framework of general rules. Yes, risk management. There are things that never change. Should you cancel your stop? No, not ever. Not ever. Period. Should you enter a position without sizing properly? No, not ever, right? The general rules that must be watched. And obviously, things like the simple things like not chasing, not taking on too much total open risk, all of those things, those are non-negotiable, right? But you have to engage your brain. And I say that not to be belittling in any way, not to make it sound like I think all of you are not intelligent, because I know you are, right? You can do this. What I'm trying to say is get out of the mindset where you have to be a robot and like you're waiting for someone to raise a flag and tell you what to do. And you have to be a decision maker, and you can learn how to make these decisions based on common sense, right? Has the market been really choppy? Have you been getting chopped up? Then maybe on your next trade, when you get to 1 hour, take a third off. Have trades been running? Have you found a lot of follow through, a lot of good supportive action in the market, and stocks have really been breaking out and holding those breakouts? Then maybe on your next trade, see if you can let a stock run a little further and take a little less off. That's it. Right. And you're not always going to get it right. Sometimes you're going to try to let a stock run to 1.5 hours. It's going to come back in on you. Right. But in general, you're trying to adapt. I keep trying to say adopt for some reason. In general, you're trying to adapt to your environment and trade accordingly. So I think I make the point here of partials. And then in terms of targets, et cetera, targets are an art. There's no science here. Right. But as we know, and I have plenty of information out there, this would be a general target for me because this is a previous high. It would be a resistance area to sell into, right? And if you're swing trading, I want to sell most of it or all of it as we head into that level. If you're position trading, then I ride one of the key moving averages with a soft stop below that key moving average. It's as simple as that. And I have a ton of material out there on that. So what's the recent question? Hi, Matt, would you buy your full position in pre-market prices moving beyond your buy stop? Partial, of course, market dependent. No. Well, first of all, we like everything else, we have to think about this logically, right? What kind of stock is this? Is this a low volume stock? Is this a stock that trades 800,000 shares and has spreads all over the place? Because in pre-market, if you've got wide spreads all over the place, those spreads are going to narrow up. And I would strongly argue to wait for the bell. Or is this Apple or Nvidia, where it's the most liquid issues on the planet Earth, right? Because then it's a little less risky. But I wouldn't buy a full position in pre-market. It's also how pre-market are you talking? Are you talking 6 a.m.? Are you talking 9:28? Because 9:28 in a high volume stock is pretty much market, right? 6 a.m. in a low volume stock is the Wild West. So again, you have to just think about your dance partner and what makes sense. Does it make sense to buy into a lower volume stock with big trades way before the bell rings? I would argue no, it doesn't. If you want, what I would do, and I do it occasionally, if it's 9:27 and there's a stock with big volume and I want to start dipping my toe into it, I'll buy a partial. That's fine. If there's a stock with a much wider spread and it's a super volatile stock, I won't. I'll wait till the opening bell because that's when the volume's going to come in. All right, so let's go to how do you handle gaps? This is a huge question, obviously, right? So let's just pick a gap. So any day where there's a gap, I am guaranteed to get this question, and I'm not belittling anybody, but I want to put the power in your hands, right? So let's make this simple. Let's say on this day, you're eyeing this up. You're saying this is a bull flag into the 9-day. This stock just reclaimed all moving averages. It showed strength on the earnings move here. I'm just going with the flow here, obviously. But let's say you pick this out on this day, and you see this coming up to this downtrend line, nice little bull flag, holding the bulk of this earnings move, held the 50-day, et cetera, et cetera, et cetera. You've got a bunch of reasons why you like this. So this is high on your list, and you're thinking of surrounding this with a trigger and a stop the next day, right? Which would put you at, let's say, that'd be a nice little 2.8% trigger to stop. So that perfectly reasonable, right? But next morning, this gap's up. This is where I'll get the question, what the heck do you do with gaps? What do you do with gaps? And here's where you employ your understanding of dynamics here, risk reward dynamics and sizing, et cetera, to make your decision, right? So this is a gap up of 3.27, called 3.3%, right? I'm going to call that a material gap, right? Just through the smell test, that's a material gap. What would not be a material gap? Let's see if I can find something that would not be considered a material gap. This name is probably not going to be so helpful in that regard. I mean, this one's a little bit better, but I mean, you guys get the idea, right? Depending on the stock. If let's say this opened up here, right? Let's just graphically give it the smell test. It opened up here, a little bit higher than the wick, a little bit higher, right? You were looking for it to push through the wick so you could take a trigger, but it gapped up a little bit higher. I wouldn't call that a material gap, right? I think we can just look at that with common sense and understand the difference, right? If it opened up right here, I would call it less of a material gap than this. This I would call a material gap. It's actually even gapping up towards, a previous swing high. So you have two choices. You don't take it, or you take it, but you have to use your understanding of risk reward and entry and stop dynamics to take it with sound trading logic and employ reasonable risk management, right? Let's assume you want to take it, and here's where it opens. Maybe you take it a little bit higher. You got a couple choices. You can take it midway through the gap, so you've got a 2% gap. These are things that are always up to you, and there's no right answer. There's no right answer, right? I will say to you that it's not that frequent that I will take a gap and go trade, because that's what you're looking for is a gap and go trade. Nobody's taking a gap up hoping that it comes back in, right? So whenever you take a gap up trade, you're hoping that it does exactly this, which is gap up and just ram higher the whole time, right? So where are you wrong? Where do you want to say you're wrong? Middle of the gap? Middle of the gap is reasonable. Gives you a 2% trigger to stop. Now you got to understand this could come back real quickly and take you out, but you've made your choice. You've made a choice. You've said to yourself, because you understand dynamics, hey, I'm going to take this tighter stop. I've got a decent chance of getting stopped out here, but if this thing works out, I'm good to go, right? And I'm not going to be over allocated. Actually, in this case, you would be slightly over allocated. Or you come down to the gap fill itself, right? If the stock fills the gap, I like to go a little bit lower, right? So it gives it a chance to fill. This would give you a 4% stop, so it's wider, right? So it's giving yourself much more room. It's going to reduce your risk reward ratio, but it's going to give you much more room. Which one do you want to do? Which approach do you want to take? Can't we use trailing stops? Yes, you can use trailing stops if you want to. You can do anything you want. But trailing stop, do you mean a percentage or a moving average? You can do anything you want. You can change it anywhere you want. So like when I'm taking a position trade, I'm going to effectively be using a trailing stop on a moving average, but I'm going to do it manually because I want to see a close below that moving average. But if you want to take a trailing stop, you can take a trailing stop. That's up to you. You have to understand the dynamics. That fits into the category of, can I do this? You can do anything. Do you understand the dynamics is the question. This, I would say the choice here is obviously your understanding of stop dynamics, right? Do you want to try to have a better risk reward ratio and say, well, if this holds half of the gap, that's going to show some real strength. And if it doesn't hold half the gap, that's where I'm going to say I'm wrong. So I'm out. That's a choice to make. You make that choice. Do you want to give yourself a little more room, lower your risk reward scenario, bring it back here, right? And if it's not a material gap, it doesn't change much. So if you have it, let's say you prepared a setup here to be just like this, the night before you prepare it, you're going to have a trigger and stop here, right around 2%, and it gaps up. Let's say it is 64.60, right? How much is that going to change it? So your entry might be right around here. Changes it a little bit, but not materially. And the way you could respond to that is maybe tighten this up a little bit, or leave it exactly where it is and just understand your risk reward ratio has just gotten a little bit lower. So the areas where it doesn't gap materially, it may not materially affect your risk reward ratio. Where there's a material gap, you've got a bigger choice to make, and use your understanding of these simple dynamics to make that choice. Another way of handling this, and which I've done several times, and I actually like doing it this way, is see if the stock actually starts roaring higher, because then it's already showing you that it's roaring higher. And if it gets up to around an area where you've got a distance of about 2% to the low of the day, you can take it that way. I've done this with AMD a few times, partly because it just goes so fast, but partly because it gives you a clear area. It's already showed the momentum that it's starting off with a gap and go, may continue. But this gives you another way to interact with this, where maybe you take this about 2% up above the open, put your stop at the low of day, and give yourself a chance to go there. Is it aggressive? It's aggressive. But I've done it, right? I've done it. In fact, AMD, there's well, that's AMED, whatever that is. AMD. What am I doing? AMD. 3 little letters. Right here, it's still on the chart. So right here, this happened. Gapped up. This is a material gap. It doesn't look like a gap on the chart because there's candle there, but this was the close. So this was a material gap up, a very material gap up. So I had my choice. What am I going to do? It started moving very quickly, so it started to limit my choices, right? But this is exactly how I approach it. Enter here, stop at the low of day, also confluent with the 20-day moving average, which just gives me another reasonable area to say, hey, I'm wrong. If this thing gaps up above the 20, moves higher, then comes back, takes out the low of day and takes out the 20, I'm wrong, and I'm willing to take that trade, right? So it's just my understanding of dynamics of the trade, right? So I took it here. My stop was down here, which was right around 2%, 2.38%, and it took off, right? Now, they're not always going to happen that way, of course, but that's the way you can start to use your understanding of this simple dynamic to approach the market how you want to approach it, right? You could have been, super quick on the draw here and taking it similar to this way, where you have to stop at the previous day's low if you were super quick right at the open. That's another way to handle it as well. But as long as you're in control of understanding this dynamic, then you are starting to take much more control of your trading. I hope that makes sense. All right, so we are at 5 o'clock. Let's get going. So that is so far. I've done. Where do I put my stop? How do you cut a trade early? Where do you cut a trade early? When do you protect break even? How do you protect break even? Where do I take a partial? Those are all kind of stop related, tactical trade. Not even some of it's trade management, but it's all execution, and it's real. I think a lot of those questions come from people that simply don't understand this dynamic fully. And I'm not saying you have to trade this way, because there's other ways of doing it. You can do the flat stop. You can do the flat 7% stop, et cetera, where you're not dealing with this dynamic at all. I would strongly argue that is a way of approaching the market that is like a brute force approach to the market, where it is not at all moving with the variables that the market presents. If you want to have a 7% flat stop on everything, to me, it is just like very, very heavy-handed and is not something that can be flexible, and you're not going to be able to take advantage of things. That's how I look at it. Doesn't mean you can't do it that way, right? But this is how I look at it. All I can do is tell you how I look at stuff, right? And then we did, how do you handle gaps, right? So what's left is watch list. Let's talk about watch list. This is going to sound a little bit like I'm being a little bit obvious, or I'm not trying to belittle anybody. I'm never trying to belittle anybody here. Let me make that clear, because I have made every mistake possible. I have been the person that had absolutely no idea what the hell they were doing and risked money in a market with having no idea what they were doing. I've been there. I have 100% been there. I have blown up an account. I've done all these stupid things, right? So please take whatever I say from a place of I get it, and there's nothing wrong with that. But I'm trying to help, and I'm trying to keep you from making these mistakes. So how do you make a watch list? It's kind of a general question. I'm going to lump a bunch of things into that. I want to make a watch list. How do I make one? Here's my answer. You want to make a watch list? Then make one. I know that sounds stupid. But really, it's as simple as that. Do you want to find a bunch of names that are industrials that you want to follow? Then look at a bunch of industrial names and make a list of them. I really think these questions come from a place where, and I don't know if it's a generational thing. I don't know what it is, but I really think these questions come from a place of everything has to have some sort of algorithmic flowchart to it, or I can't do anything, right? Like I can't even Google anything unless somebody has a flowchart telling me how to Google it. And I'm not trying to be a jerk here. I'm really, really not. But I do think some of these questions come from a place of everything must have some set, exact flowchart, or I can't do it. And there's no right way to make a watch list. Like everything I'm trying to show you here, take control of it. Understand what you're doing. Engage. Don't just sit there and blindly follow some scan and think you've got some magic list of stocks, because all that is a list of stocks. Every single day, there's a full list of about 9,500 stocks, right? Every single day it's out there. Everybody has that list. What list do you want to make out of that? How do you want to whittle it down, right? So I've shown you guys, look at the scans and watch list webinar, because I discussed how I use it. I'm not somebody who runs, a dozen scans every night for this and that and this and this and this and that. I don't find that useful. What's much more useful to me is simply looking at charts, looking at price action, and I don't need 15 scans for that. The reason I use that relative strength scan is because it is going to show me with some clarity what is showing some real technical strength. In any market condition, it's going to show me what is showing some real technical strength. And by looking at that list in terms of sectors and things like that, you glean some information. But it's just part of the puzzle, right? It's part of the top-down analysis that I do. If you're looking at what the indices are doing, if you're looking at what sector ETFs are doing, if you're looking what different industries are doing, you're already going to have, that's already basically like a form of scanning the market, right? If you're looking at the market and small caps are just getting destroyed, and it's only the Qs that are working out, which we've seen in the past, then probably you should be looking at stocks that are technology stocks. It's kind of as simple as that. There is no magic scan. I know people really get tied up on this to the point where I think people feel as if they can't make a watch list unless there's some system to it, and it's just not true. Like, do you want to find strong stocks that are in the financial sector? So here's my scan, my typical scan, 750K and above $10. Simple moving averages, stack 20 above the 50, above the 200, right? That's it. And I make it, show strength, right? So this is kind of an arbitrary number, but let's say, let's just keep it at 0 monthly performance. So we get a lot of hits. Want to find strong stocks in the financial sector? Boom. Hit the financial sector. There's a bunch of strong stocks in the financial sector you can look through. It really is as simple as that. And then people will be like, well, so how do you make this broader watch list of, I have this broader watch list of stocks that I have. There's about 500 stocks or so on this. How do I make this? I just go through some stocks in different industries and pick some because I just want to get a feel for the market. This doesn't even have the stipulation of 750,000 shares, average shares, or $10. So I just pick stocks because I'm allowed to. There's no law against it. I can just pick stocks that maybe are representative of a theme, or stocks that have been strong, or stocks that were recent IPOs, whatever, to give me a broad representation of the market from different sectors. And I just literally pick them. There's no scan. You can pick whatever you want. Pick an ETF. Do you want to be able to follow all the industrials? Make a watch list. Here's the industrials in the S&P 500. Whoa. So here's a list of the industrials in the XLI, right? Make a list of them. Then you can flip through them anytime you want. So the whole watch list thing to me, it's going to sound like I'm being a jerk, and I am really, really, really not. I'm really not being a jerk because I get it. I get the instinct to, there must be a system for everything, but you are allowed to make a watch list. You are allowed to make a list of stocks. And guess what? There's Google. There's all sorts of resources that show you the holdings of ETFs. You've got to do some legwork, right? So when people ask stuff like, well, so what are the stocks that are strong? And, what are the strong infrastructure stocks? You can Google it. You can simply do some research and Google it. Don't be afraid to just make a watch list. Do you want to see all of the holdings of a certain ETF? Go in there, find out what the holdings are, and dump it into a watch list. It's as easy as that. Something like DeepView or CoiFin, they do it for you, right? TradingView doesn't do it, but it's not a big deal. I've had people, ask me, where did you get this list of the 100 names in the queues? Where'd you get that? How do I get that on there? I don't know. Am I the only one that finds that crazy in a point in time where there's more information available to human beings than has ever been available by an exponential number? Where did I get them? I looked it up and then I typed them in, right? It's not that hard. It took me maybe 4 minutes. And again, I'm really not trying to belittle anybody, but take some initiative, take some ownership, start making watch lists of stocks that you think are notable. Split them up into some categories. It's not a science. There's no right way to do it. And this is another thing that pisses me off about some services is what they are literally selling you is a scam. Some services are literally selling you a scam that anybody can do, and they act as if it's some super proprietary thing. It is simply a list of stocks. A list of stocks doesn't trade for you. It's a list of stocks. You have to know how to trade. You have to know why you're looking at that list of stocks. All right, so I hope I made that clear, and I feel as if I really have elaborated on how I handle watch lists and why I have them and what they do for me. And take a look at the scans and watch list webinar if you have not. Getting even better to research technology too. Yes, I mean there's so many things at your fingertips. One of the things that pisses me off about Twitter, and there's like an endless list of them, is I will get questions from people that just Google it. Just Google it. Like, why are you asking me? Just use Google. I don't get it. Maybe it's a generational thing. I don't get it. But those are the people that are not going to be successful trading. Those are the people that are not going to be successful trading, because if you can't have any form of self-initiative, self-motivation to find a simple Googleable answer, trading is not going to work for you, because you got to make decisions. You have to be able to solve problems for yourself, right? I think it is generational. I mean, maybe I'm old guy now. I'm 50. I'm going to be 51 in 2 weeks. Maybe I've like reached that point where I'm the guy that's like, what is this crap you're listening to on the radio? You know what I mean? I fully admit that, but it is astounding to me because, look, I didn't have services. I didn't have anything like this. I had to bang my head against the wall. I didn't even when I first started trading, there wasn't email. I mean, you gotta solve some problems, and that's what helps you. There isn't a single trader alive that simply has been force-fed or spoon-fed information, right? All right, sorry, I'm getting like a little explosive here. Let me go through these other two really quickly. Do you use 5-minute charts? I do not, right? I will use 5-minute charts in that I'm looking at this day. This shows me the kind of the character of the day, which, by the way, is a massive chop fest, right? So that's where I find it useful. 5-minute charts, if you're going to trade a 5-minute chart, you're going to find a trend on a 5-minute chart. You're going to find a trend in complete chop in a 5-minute chart. You're going to start doing stuff like this. If you're trading a 5-minute chart, you're going to be like, oh, we're launching higher. No. It's a 5-minute chart. Know your time frame, right? This was the candle, right? But you're going to find a trend in a 5-minute chart, and it's going to take you off of the trend. It's going to take you off of the time frame that you should be looking at for your primary signal. For swing trading, for me, daily chart is the primary signal, right? This, by the way, looks like a nice short right there, doesn't it? I don't know how I ended up on that chart, but daily charts for swing trades, weekly charts for position trades. Why? Because the higher time frame takes precedence. Let's look at the weekly chart. For some reason, I ended up on this stock. The weekly chart is clearly showing a strong uptrend that is probably due for a little bit of a pullback, right? That's some information to get. You're extended from the 30-week SMA. Daily chart, you're double inside here below the 20-day, right? So those are the things that are taking precedence. You're extended on the weekly chart. You're extended from the 30-week SMA. You're double inside here below the 20-day. What is the 5-minute chart going to tell you that supersedes any of that? The 5-minute chart is going to tell you how to trade in a 5-minute time frame. If you want to be a day trader, look at the 5-minute chart, right? It's really as simple as that. I know people want to be surgical and use the 5-minute chart and stuff. And if people can use that to their advantage, and I know that some people do, go for it. To me, it is the wrong time frame to be looking at for the way that I trade. If I was a day trader, absolutely, I'd have 5-minute charts up. I've seen people that say that they look at 30-second charts. Know your time frame. Know your time frame, right? I do not make any decisions based on intraday charts. None of them. Sometimes I'll look out of curiosity to see, where they do start to line up is if there's a key level on a daily chart, and then the 5-minute chart is kind of consolidating right near that key level, then you will start to see the time frames line up. But until and unless that happens, and I'm not looking for that, because the daily chart or the weekly chart is always going to take precedence. All you're seeing is the 5-minute chart, a fractal of a fractal of price movement within those larger time frames. But if you're not seeing something like that line up on multiple time frames, then what you're seeing is noise on a 5-minute chart. And by the way, if you want to glue yourself to a screen for the entirety of the session every single day, start working with 5-minute charts, because you will be glued to it. You will not be able to get off of it. You will be stuck there for the entire session every single day, pressing buttons all over the place, thinking that you're finding some big move, thinking that you're getting early on some big move, and you'll likely chop yourself up. So the main reason I do not trade 5-minute charts is because daily chart, weekly chart take precedence over the 5-minute chart. That is just simply the truth. This is a yearly chart takes precedence over monthly charts. That is a truth of technical analysis. The larger time frame takes precedence, and I am not trading on the 5-minute time frame. If you're trading a 5-minute chart, you should be expected to close out your trade in 5 or 10 minutes. Think of it that way. On the daily chart, I should expect to close out my trade within a day, and I do. I might have to close out my trade that day because I'm on the daily chart. I might have to close it out the next day because I do. If I'm taking something based on a weekly chart, ideally, I'd like to let that trade run for weeks, right? It's a simple concept. And then finally, possibly the most just nebulous and kind of misdirected question there is out there, and I do get this a lot. I don't get this on the site, but I get emails, like tons of emails with this question, right? And I think it's just misguided. How much can I expect to make, and what are your returns, right? And my answer here, after I went through all that, should not surprise you that there's no answer to that. It should not surprise you that there's absolutely no answer to that. There's no way to answer that question. It's not possible. I can tell you what my returns are, because that's a fact. How much can I expect to make? There's no way to answer that question. And the only reason somebody's asking what are your returns, because they're trying to extrapolate that to mean your returns are what my returns are going to be. And that's not true. It's simply not true. And I know tons of people think that when they join the service, that's what you're going to do, is you're going to emulate that person's returns. So they better be making a killing, because that means I'm going to make a killing. And if they're not making a killing in this year, then I'm going to be a loser this year. You can be on a service where the person is getting chopped up and you're doing well. Because there's variables in the market. We're all different. We're all completely different people. We should not be taking the same trades. There's no reason to be taking the exact same trades at the exact same moment in time. That makes no sense. Think about how first of all, it would be, the odds of that happening serendipitously are extremely low. There are times where people are honed in on a single chart, and a lot of people are taking that chart, but they're still not taking it at the exact same level, with the exact same positioning, with the exact same sizing, with the exact same entry. None of that is happening. They're not taking partials at the exact same time. So to think that you're going to exactly emulate somebody's returns is it's nonsense, right? So there's that part of it. So that part of it is what I want to, make clear, is that you shouldn't join a service to emulate somebody's returns. You should join a service to try to better your returns, period. And how much can you expect to make? Look at my realistic expectations webinar, because there's no answer to that. There is no answer to that. How much risk are you taking? What's the size of your account? What is your overall way of interacting with the market? Are you someone that lives in Australia? Are you someone that's on the screen all day long? Are you staring at 5-minute charts? How are you trading? How am I supposed to answer a question like that? What it shows me is that so many people just don't understand or do not internalize the fact that this is a probabilities-based endeavor, and that everyone has to interact with the market in their own unique way amidst a larger framework. There's no doubt that there are larger frameworks, right? The things that I've repeated many times: trading with a trend, exploiting consolidation patterns, etc., looking for relative strength, all that stuff, all the stuff that I've said a million times, using simple moving averages, all the stuff that I've covered in all these webinars. There is a framework, right? But that doesn't lead to we're all going to make 33.47% returns this year. I mean, think about the absurdity of that. Even if I said to somebody, oh, yeah, take my course and join my, join my site, and you're going to make 45% returns. Shouldn't I be like in prison for saying something like that? But people say that all the time. People say that. People will be happy to say that to you. There are so many variables you can't possibly account for them. Every one of us is different. Different account sizes, risk tolerance, psychological strengths, time to devote to trading, etc. There's no standard return, and my return should mean nothing to you. Why have I shown my equity curve recently? Only because I'm trying to show that by these defensive tactics that I take, what I'm doing is smoothing my equity curve, which for me at this point, where I'm suddenly the old guy that thinks there's a generational problem here that people can't Google. I don't want massive volatility in my account. I don't want that. I'm not 20 anymore. I'm not 20 with a $10,000 account and I want to become a billionaire in 4 months. I have achieved a certain level and I want to sleep at night. And I definitely want to compound my returns and I'm doing so, but I don't want that to come at the expense of massive. I don't have any hair left to lose. I don't want that to come at the expense of massive drawdowns and massive volatility in my account for a host of reasons. Not all of which is just my risk tolerance, but it's because to me, that is much more like gambling, right? So that's not the way I trade, right? So that's the only reason I even showed my equity curve, because I think everybody should be aware of the kind of equity curve they want, right? You're going to say, oh, I want my equity curve to go up. They're like, yes, I get that. But do you want this violent EKG looking thing? All right. So I think that really wraps it up, right? I think in conclusion, I always manage to go over here. You got to be a decision maker, right? All of these things are about being a decision maker. And what I try to do here is just empower you with some simple tools. Meanwhile, watching how I'm navigating the market and doing the top-down analysis every day. And every market's different. Every market is different. We're going to see different markets in the next 10 years that we've never seen before, right? Everybody likes to pretend like there's this historical precedence for everything. There really isn't. There are some general guidelines and things tend to rhyme, but the market is different. The world changes. The economy of the planet changes. I mean, it's a fascinating thing. So to expect that anything can be pinned down in simple formulas is kind of silly. So you have to be a decision maker based on, general guidelines and risk management, of course. But understanding these real staple dynamics, I think, should be the heart of how you make decisions. Start to engage more. And by that, I mean, don't just simply say, oh, this is my trigger. There's my target. Engage more. What's going on here? What's your risk reward? How has the stock behaved before? What's the environment? Engage more. Start to think about things more. And I don't mean this to be belittling again, because I think a lot of us have a tendency to kind of be a little robotic about it, but you're not going to be a good discretionary trader if you want to be a robot, right? If you want everything to be an algorithmic flow chart, then you need to be a system trader. You need to have some sort of system that's that can be back tested, like a moving average crossover or some sort of indicator that crosses some threshold, right? Things that can be back tested. What discretionary traders do cannot be back tested. I don't know how many times people ask me, have you back tested that? You can't back test this. How am I supposed to back test, some of these entries, that AMD entry I took? You can't back test that. That's discretionary trading. There's no way to back test that, right? There's no way to back test my perfect, place to take partials. It doesn't work that way because there's so many different variables, and I'm taking things based on a lot of those different variables. One of which being the environment, right? The things that are able to be back tested is things like 20-day crossing the 50-day right here. What happened after that happened? That can be back tested because you can spot it, right? And a computer can go back and spot it, right? So you have to be a decision maker because you're a discretionary trader. If you don't want to be a discretionary trader, then you have to understand that either you should be a system trader or you should stop trading. I have to be as blunt as that. Like if you don't want to be somebody that wants to engage and think and make decisions, then discretionary trading isn't for you. And I bring this up at the end because I think everything I've talked about here has been highlighting the discretionary nature of it, but it's not random. There's randomness in the market, in the world, in reality, of course. But what you're doing is not completely random. There should be frameworks. There should be logic to it. And you should use things like that position sizing tool to express your logic and your unique psychology in what you're doing. But it is, make no mistake about it, The decision making comes from you. It doesn't come from a flow chart. I saw somebody post these elaborate flow charts on Twitter. I mean, like 6 screenshots of these elaborate flow charts for like every decision. And I mean, that's great if somebody wants to operate that way. But man, that is definitely not the way I operate. And I would imagine just sitting there unable to press a button because you're going through flow charts and stuff like that. And maybe it's a good representation of kind of like a lot of aggregated different thoughts and variables and ways to act. But if you really need to look at a flow chart to act, you're just going to get mopped up. You have to be able to have a logical, simple system, right? So that's what these simple dynamics is what I'm trying to show. And I think, I felt like this was an important one because I think that these frequently asked questions show that people really don't have the mindset that I'm talking about, where here's a way to express your logic by understanding the dynamics of what you're doing. Want to take a little more risk? Here's how you would do it responsibly. Want to give this a little more room? Here's how you do it responsibly and how it affects your trade. Want to take this trade that's not a perfect setup, but it's near a key area? Then you can do that, right? You can do that by understanding what you're doing with your risk reward. So all the power starts to become in your hands. Now, it doesn't mean you're going to be suddenly super successful and every trade's going to work. You're still going to have most likely more losers than winners, but it means you will be more in control of what you're doing and understanding more what you're doing and feel more confident in what you're doing, right? And so then these frequently asked questions will not be most likely coming from you because you'll be moving on to the next level, which is, the mental game, which is all about, keeping your confidence up and understanding the environment and persisting and all that stuff that I talk about, which is the real nuts and bolts of trading. All right. So now this has been, an hour and 23 minutes. I'm going to go through really quick here what I'm looking at. So